Hey everybody, Courtney Smith here, and I'm so excited about our special presentation. I'm going to say tonight, I don't know what time it is where you are, but it is pitch black outside here in Dubai, United Arab Emirates. So I gave this presentation early this morning, and really all the presentation is me answering your questions. I've gotten several more questions since I did it this morning, so I'm going to put those questions at the beginning. Because if you're here to watch this a second time, I don't want to repeat what we did before. Now, this morning, we had some internet problems and there was some sound problems. I think the visuals came through all the time, but really this is an audio presentation more than a visual presentation. So I checked my internet. I've got 40 MIPS upload speed. That should be more than enough to get through. Anything over 5 should be okay. So 40 is fantastic. So we'll do our best. What can I say? So let's do this. Let's get right into it. So what I'm going to do is I'm going to go over to the presentation in a second. You won't be able to see me. I'll be hiding back here. I'll be hiding behind the presentation. And I also have over on the right-hand side, you can see there's a place to put in comments or questions. So feel free to watch, to put some questions over there. All right. There we go. Questions. See? So I'm watching myself. All right. Okay. I've already got one thumbs up. All right. That's fabulous. All right. So let's get going. I'm going to switch over to the special presentation and we will carry on from there. All right. So once again, the first 3 questions came after this morning's presentation. So let's start out with those 3. I have a question on how to trade the stocks you recommend in Wealth Builder using options. I think they're talking about Wall Street winners. I want to use simple calls. What parameters should I use? Well, my preference is to use the 30 delta and have the option be at least 6 weeks in the future. And really, the longer you can go out, in other words, I'm recording this in early July, it would be great if you could put on a December option, because then the price of the option per month is the lowest. So you have a trade-off here. The trade-off is you want the longest one you can get, but the bid-ask spread on a December is usually wider than in a September. So you have to take into account the bid-ask spread. So a 30 delta as far out as you can, as long as the bid-ask spread is reasonable. That's the best I can do for you. Second question, is it possible to make a 3 to 5% return per month on a portfolio of 100 to 200,000 dollars using credit spreads, put sell, etc.? I've seen a lot of videos on YouTube on how to sell covered calls, cash secured puts, or wheel strategy. The short answer is yes, but let me explore it a little bit. I managed a covered call fund for many years, and the average return was 14%. Now, in the real world, I make over 50% a year when I use covered calls, and I often make 100%. So why the difference between, let's say, 50% and 14%? Well, the mutual fund had hundreds of millions of dollars, which meant that I could only sell options in the most liquid stocks. So, of course, that reduces returns. In my own trading, I like to be a little bit riskier and sell calls on stocks that maybe are not blue chips. Maybe they're turquoise chips or red chips. No, they're not red chips. They're not Chinese stock. But you know what I'm saying. They're just not that good quality. So that increases the risk, but dramatically increases the performance. Selling naked calls is the same as a covered call. So the same thing applies to that. Although the mutual fund, I was not allowed to sell naked puts. So yes, you can do that all the time. What you want to do is start out preferably with a high dividend paying stock like IBM, basically the pit bulls of the Dow strategy that we teach in some of our classes are the perfect stocks because they're good stocks, they're in bull markets, and they're usually yielding 3.5, 4, 5%, something like that. So you start out with some income, then you sell the option against it. And for example, I was looking at Cisco. And if I were to sell an at-the-money option, which I try to do, and I did it for August expiration, it was about a 50% annualized return. So Cisco's a big liquid stock. It was like 52%. So, and that was just hitting the bid. That wasn't trying to get a middle or anything like that, which would have boosted that up to about 60%. So you can do it. There's no question about it. Try to be conservative, control your risk, all the usual types of things. Okay, so a related question, but from somebody else here. Here's which option to select for short-term trade. So this would be swing trading, 1 to 3 days. Avoid too expensive options, yes. Where market maker premiums are too high and volatile. All of those things are true. So Dirk, what I do when I swing trade using options is I actually go in the money. I'll go maybe a 60 delta. And I can argue 60 delta or 30 delta. There's differences between them. Swing trading, the way I do it, I'm trying to find strategies that make money 80 or 90% of the time. So in that case, I'm not so much risk averse as profit oriented. So that's why I'm looking at in the money. Like I say, maybe a 60 delta. If I'm less sure about the strategy, I would probably go for a 30 delta because then my dollar risk is much smaller. Normally, I prefer to buy 30 deltas. 2 30 deltas is way more cost effective than 1 60 delta. But since we're only in the trade for a few days, I want to get the maximum bang for the buck. I could go higher, but then there's no leverage in having the option. So that's why I tend to go for 60 or 70 delta. Now, days to expiration doesn't matter. You're only in it for 2 or 3 days. So normally you're going to go maybe 1 month out. So right now I'm in the first week of July. So maybe I'd go for an August. That would be 6 weeks to expiration. So, 4 to 8 weeks is a good time period, but it doesn't make a lot of difference because time decay is not your enemy in a 2-day trade. Okay. That's not your enemy. It's price action is your enemy. So I don't really care about time decay. So short-term options can be just fine. Now, you then go on and ask about IV, HV. IV, for those of you who don't know, is implied volatility, and HV is historical volatility. Since you're a buyer of options and you're only going to hold them for 2 days, it doesn't really matter. Look, ideally, you'd want to have the options. Since you're a buyer, you want to make them cheap. You want them in the low end of the range. But the reality is, if you're only in the trade for 2 days, there's probably not going to be a big change in implied volatility unless earnings are coming out tomorrow, okay? So you're pretty insensitive to some factors. So the key is you just got to make money as quick as possible. That usually means a higher delta than I normally do. Okay, what are your thoughts about Ichimoku Cloud for the 10-minute, hourly, and daily timeframes? 30 years ago, I was something like that. I can't go back that. Maybe it was 20 years ago. It was way long ago, okay? I was in a very small mastermind group of elite traders who I can't give you their names, but they were all professional traders, except for one gentleman who was the secretary of the cabinet. Yes, the cabinet, the president sits there. He's in charge of the cabinet. Somebody's in the room controlling the agenda and taking all the notes. That was his job. So a very, very senior government official. He had all the secrets. So it was a very elite group, and we met once a month and we discussed strategies. And one of the gentlemen got all excited about the Ichimoku Cloud. So, of course, I respected everybody in this group. So what did I do? I analyzed it as much as possible. And I got to tell you, I came back. Now, this is 20 or 30 years ago. I came back and said, I can't figure out how to make any money from it. So I haven't looked at the Ichimoku cloud now for 20 or 30 years. So maybe I should go back and take a look at it again. But based on my analysis a long time ago, I couldn't see any value in it. It was too fuzzy. It was too cloudy. I couldn't get crisp, clear rules, which is part of my trading philosophy. Okay, let's go back to the questions that we did this morning. So if you've heard these, maybe the sound wasn't good and you want to stay here. Maybe you asked one of these questions, but we'll get through them all. And then you should be putting questions over in the comment box that I can answer when I get through all of these. Thank you very much for streaming these valuable shows. They are valuable. I have a question. What do you think of brokers who do not allow to trade IPO companies, specifically eToro? Any reason? Yeah, sure. Let's divide IPOs into hot IPOs where the stock usually pops up 20, 30, 40, 50, 100% on the day that it goes public, and not hot IPOs, and they just go nowhere and maybe even sag, okay? You're never going to be able to buy any hot IPOs unless you're trading 1 million shares at a time. Me, even though I'm a senior professional, well-known, TV, books, blah, 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 no broker is going to offer me any hot IPOs. Now, when I was running mutual funds, they would knock on my door. They would line up outside my door to get me to buy hot IPOs. The brokers use hot IPOs as a reward for being a really big, profitable customer. I'm not a real big customer of these brokerage houses anymore. As a mutual fund manager, as a chief investment officer of a mutual fund company, as a hedge fund manager, I was swinging huge positions, million share orders. Trust me, they were competing very hard for my business. They don't compete for it now, so they don't offer me hot IPOs. If they offered me a not hot IPO, I wouldn't take it. Because if they offer it to me, that means that the big money didn't want it. Well, why didn't the big money want it? It makes me nervous, so I wouldn't even take it. So I don't really pay a lot of attention to IPOs because I don't get the hot IPOs and I don't want the non-hot IPOs. Now, you then go on and say, what's your thought about trading IPO companies? I know you're a strong proponent of the best, but as a long-term investment, don't you believe it can be a decent alternative? It can be. There's nothing wrong with it. They have to give you good financials, but I can tell you, having been involved on the issuer side of several IPOs, they're painting the tape. In other words, they're making their financials look as good as possible when they go public, and then you'll start to see some bad news come out after they become public. So why buy them during the IPO? Why just wait for them to sag? Okay, but those are going to be the not hot IPOs. So I'm still asking the question, why bother? The problem is we have no technical analysis we can do on them because they're not trading yet. I prefer to wait about 6 months after the IPO because then at least I can get a handle on, is it in a bull market, a bear market, or a neutral market? Because that one question drives a huge amount of the profit in my portfolio. All right. So why not be patient? They'll be there tomorrow and there'll be another IPO the day after. So no rush. All right. I've been reading your book, How to Make a Living Trading Foreign Exchange. I find this book to be very interesting and informative. Thank you. To be a successful trader, one must be able to determine whether a currency pair is trending bullish, bearish, or sideways. Absolutely true. Therefore, I would appreciate if you can comment on the subject of trend analysis, especially the rating of swing highs and lows. I believe your comments on the subject of trend analysis will benefit all attendees, and I agree with that. So thank you, Retnam. So what I did was, in the old days, when dinosaurs roamed the world, I was trading about 42 different systems. That was obviously ridiculous. So, and I was making money, but I was doing a hell of a lot of work. So I did a couple of things. Number one, I did 80-20 analysis. I got 80% of the profits. I did 20% of the work. Much better. Okay, much better. But what I also did is decided to start all over again. So I sat down and I said, well, what are the basics of trading? The absolute rock bottom basics that you have to do. Don't get distracted by the tutti frutti. Let's stick with the plain vanilla. So this is what I came up with. If it's a bull market, you must be long. If it's a bear market, you must be short. If it's a neutral market, you must get back into the pool and order another pina colada. Okay? That's it. Why? Because you can only make money buying in a bull market. You can only make money selling in a bear market. And if it's in a neutral market, you're going to have a hard time making money. So don't try. Now, that's the most basic statement you can make about trading. And yet, so many people don't do it. So then I said, okay, well, there's a definition of bull, bear, and neutral markets. It's been around for 120 years. And the definition is this. A bull market is any market that makes higher highs and higher lows. So the highs are getting higher and the lows are getting higher as well. That's a bull market. A bear market, lower highs and lower lows. And a neutral market is anything else. Okay, great. Now we have a definition of a bull or bear market. But now I need to know what's a high, what's a low. So in this discussion, high can mean the high of the day of the bar or the candle, but it also means a swing high or swing low. So the market trades up for a few days, makes a high, then it trades off for a few days, makes a low, then starts to trade up again. Okay, so I'm going to I'll call swing highs the ones that take several days to occur, and high to mean the high of one bar or one candle. So what I realized, of course, is that a high, a swing high, is defined as any bar that has a lower high on the right side of it and a lower high on the left side. So it pokes up and both bars on either side are lower. They have lower highs. That's a swing high. But of course, there's a million swing highs that have one bar to the right and one to the left. Notice that we have to wait till the day after a swing high, before we can say it's a swing high. Okay, so now what we can do is we can say, when we say it's making higher highs and higher lows, is that swing high, and two of them in a row that are higher than each other, is that a bull market? Well, then I realized that there's a million, what I called a one bar higher low. And that would be where there's one bar to the right that's lower than that one, and just one bar to the left. And then if we go back 2 bars, that bar has a higher high than the swing high we're looking at. So I said, okay, I need to have one to the right of the swing high and 3 or more to the left. Now I said 3 or more, which works 90% of the time, because that means it's a significant higher low. It's not a trivial little blip in the market that caused a 1 bar higher low. Now I've got the definition of a bull, bear, or neutral market. And when I say it's making higher highs, I now have a definition for higher highs. I know what a high is. I know what a low is. And these rules are plain and simple and clear, which means that everybody on this call can come to the same conclusion all the time, every time, of is it a bull, bear, or neutral market. So I called that technique trend analysis, and then I created rules of where you would buy, where you would sell, where you would take profits. And those are all in the book that Retnam has bought and is reading. We also teach it in our foundational courses, because it's one of our foundational trading systems, because it's the ultimate system in a way, because it's exactly the basis for nearly all other systems. All other systems are based, not all, 95% of all systems are based on trend analysis. All right, so the message is focus on what is the trend and go in the direction of the trend. The trend is your friend until it ends. Okay? All right. Let's go on to our next question. Thank you for answering our questions through YouTube live streams. Number one, for the beginner option trader with limited capital, what are the safest strategies to use? A credit spread? Yeah, a credit spread's a great strategy to start with. I would say any vertical spread. So that would be credit or debit, but just a vertical spread. Well, what is a vertical spread? Well, in the case of calls, it would be buying a low strike call and selling a high strike call. That's a spread. I bought a call, I sold a call. It's limited risk. You know exactly to the dollar what your risk is when you get into the trade, and you know exactly your maximum profit you can make as well. It's a limited risk, but it's also a limited reward. But the odds are in your favor. So let's say we have a nice bull market. We're making higher highs and higher lows, and we buy a vertical spread. So that would be buying a low strike call, selling a high strike call. We can analyze that very easily, and we can know exactly what our profit and loss potential is. Now, generally speaking, the profit and loss are pretty close. Maybe I make $60 and risk 40. I often will be trying to make $50 and risking $50. That's not uncommon. It's very rare. It's not rare. It's uncommon to be potentially making $70 and risking 30. What you're really doing is putting yourself in a situation where maybe it's 60-40 or 55-45 in your favor, but that the odds of success are high, that you have an 80% chance of making money on the trade. Then you've got a good trade. Limited risk, very low capital, couple $100, that kind of thing. So it's a very, very good strategy. All right, shifting to a completely different topic. When adrenaline shows double bullish, does it mean to double the size of the positions for all stocks that you plan to trade, or only for stocks in the NASDAQ? Now, that's a great question. We have an indicator that we have in the fully paid up members section of Wall Street Winners, and that technique is called adrenaline. It's a fantastic technique. And one other thing, and you can get the free version of Wall Street Winners here on my YouTube channel every Sunday night. So check that out if you're a cheap person. But if you're interested in making money, you might want to subscribe to the paid for version. So adrenaline is a technique where it has three modes. Number one, bearish. Number two, bullish. But then there's a third one called double bullish. And double bullish, when the adrenaline triggers double bullish, the market's usually screaming very powerfully. So your idea is right, Vicky, I'm just going to say to increase the size of the position when it's double bullish. When it's bullish, you have a regular size position on. When it's double size bullish, you should put on a bigger position. Now, how much bigger? I can't answer for you because that's a personal finance question. How risk averse are you? You know, how much do you want to make a lot more money? How much do you want to control risk? These are all questions that only you can answer, but you should definitely increase the size. Maybe not double, maybe 50%. And I would do it for all stocks, not just the NASDAQ stocks, but definitely for the NASDAQ stocks. I think the rest of these are just comments. So thank you very much, Vicky. Those are great questions. Okay, I'm doing covered calls as part of the option paycheck class. We offer an online course called Option Paychecks, which is designed to teach you how to create income from option strategies so you can quit your job, live a global freedom lifestyle like I am here overlooking Dubai. Actually, the direction I'm looking right now, I'm looking mainly at dirt and sand, okay? The big tall buildings are behind me, but my window is a long vista of dirt and sand. All right, please clarify when it's time to decide the trade is not working. Do you hold it to get a bounce to get out? If you're doing a covered call, the most important part of the covered call is the stock. So the first thing you do before you put on the covered call is you determine where you're going to stop yourself out of the stock. So I've got a nice little bull market, and then I look down and I say, oh, here's some significant support down here where there was a major low. I'm going to put a stop loss below that. Okay, that's step number one. Step number two, you now, let's say it's $100 stock. And let's say that major support is at 90. That means your risk in the stock is $10. So what you're going to try to do is have the option premium that you're selling be worth $10 or more if you can. Maybe it's only $8 or $9, but you're going to want to get as big a premium as possible. And since you're selling overvalued options, there's a good chance you'll get a good premium. So now what's going to happen is this. Let's say it's $8 premium. So we're buying the stock, getting $8 of premium, and the stock starts to go down. It gets stopped out at 90. That's it. You're out of the stock, because if it keeps going down, you're going to start losing a lot of money. Now, the option premium started at $8. It's probably down to $1 when you get stopped out of the stock. So I usually hang on to the naked short option and let it expire worthless. So I pick up $8 on the short option. I lose $10. I end up losing $2 on the trade. I can handle it. The ideal is if you can get stopped out and still have, like you get out at 90, but you sold $12 of premium, so you can end up with a profitable trade, no matter really what happens. There is an exception to that, of course. So it's each trade has its own metrics and scenarios, so you have to keep looking at it. But the key is, when the trade's not working is when you're stopped out of the stock. You ask, should you hold to get a bounce to get out? No, because you know what? The bounce could be at $50. I bought the stock at 100. The bounce could be at 50. I can't. Hope is not a trading strategy, and that's what hanging on for a bounce is. That is a sure way to lose much more money, is to hold on to get a bounce to get out. I heard it a million times. Those people are not pro traders. Okay. I've never seen the complete rules of how to divide the funds for one's portfolio, as in what percentage do you invest of the available funds and when do you get out of the trade? Well, the answer is you should try to invest all your money. You don't want your money sitting there earning zero. You want all your money working if you can. And as long as it's within your risk parameters, you want as much money working as possible. So the reason why there's no complete rules is because it depends on you. Are you a risk-averse person? Are you conservative? Are you a gambler? Are you young? Are you old? Do you have lots more money sitting in the bank, so it doesn't matter if you're wiped out on your investment? These are all questions. Before I could give you any advice, I'd have to ask you a lot of questions to understand your needs and desires. But for example, a person who's 20 years old, put it all on speculative stocks, because if you're wiped out, you've got many, many years to get the money back. Well, what if you're 70 years old? I'd probably put most of my money in conservative investments, because that's not a time that you don't have as much time to get it all back, okay? A third question here. What are the indexes, funds, stocks specifically used to trade Bitcoin? Well, I don't like trading Bitcoin itself or any of the cryptos, because the commission costs and the bid asks are so big that it's like, I'm insulted. I even keep thinking I'm going to set up my own exchange and drive down the bid ask spread. But so I use the futures contract and the CFDs, contract for differentials. CFDs are not available for Americans. They're available for everybody else. And they're basically mini futures contracts. So I prefer the futures because I know I'm going to get my money back. The futures exchange has AAA credit. There's Coinbase, Binance, all the big exchanges. They don't have, they're junk bonds. People are losing money all the time through scams on those places. Nobody loses money for scams on the futures market. It's theoretically possible to get scammed on CFDs, okay? So the safest way to trade Bitcoin would be on the futures market. Please explain SIPC and FDIC protection for trading accounts. Okay, So FDIC has been around since the 1930s. Federal Depository Insurance Corporation or something like that. And what it does is it is insurance for your bank account up to $250,000. So if you put $250,000 in a bank and the bank goes bankrupt, the federal government will give you $250,000. If you put in $350,000 and the bank goes bankrupt, the federal government will give you $250,000 and you lose $100,000. It's capped at $250,000. SIPC, which is Securities Investment Protection Company, something like that, okay? SIPC, everybody knows it as SIPC, is the same thing, but for stockbrokers, and it's $1 million. So if your broker goes bankrupt, you're insured up to $1 million. Now, I know most of you don't have accounts that small. Most of you are trading $5, $10, $20 million. I understand, but that would suggest you need to open up 5 different accounts at 5 different brokers so you can get $1 million back from each account, okay? And that's really what they are, is they're federal government. You actually pay a little fee when you trade a stock, a little fee that goes into SIPC. You actually are paying a little fee on your account that goes to FDIC. The bank sweeps it out of your account. The broker sweeps it out of your account. So if you have a lot of money, think about opening several accounts, several bank accounts or stock brokerage accounts. Just remember the limit right now is $250,000 on FDIC, $1 million on SIPC. Most overseas countries, non-American countries, don't have schemes like this. A few do, but most do not. Most of them, they say, look at the balance sheet, see how good the balance sheet is before you open an account. Okay, Sushil here from India. When should we take a sell call on our long-term investments? Whenever the options are overvalued, okay? So you got to figure out if the options are overvalued or undervalued. I don't have time tonight to go into how to determine that, okay? But but what happens is that once you've determined the options are overvalued, it's not a bad idea to be selling calls on your long-term investments all the time. But you should never sell calls that are undervalued because that'll actually reduce your profitability, not increase it. Now, you talk about you want to sell calls on a fundamental basis and not technical. Not sure I'm a big fan of that idea, okay? Not sure I'm a big fan on that idea. But once again, it comes back to only selling overvalued options. If you go to Options University, we've got 1 million courses at Options University that tell you whether an option is over or undervalued. You can go to OSS 2021. That's the course that I teach, but optionsuniversity.com has a lot of different courses. Overvalued, sell them. Undervalued, buy them. Fairly valued, don't care. Who cares? All right. You shared that people thought it will be the end of inflation as the Fed talked about raising interest rates twice in 2023. Why does the end of inflation cause people to buy long-term bonds and result in an increase in the bond price? Can you explain and share your thoughts on the bond bubble? Sure. If you're a bond buyer, or let's say you buy a 10-year note, we can look at 3 different factors that affect the price of a bond or a note. The first one is called the real yield. That's the money I want to make. I want a profit on my interest that I'm receiving. But let's go to number 2, credit risk. Whenever you buy a bond, there's a credit risk that the person who you're lending the money to doesn't pay it back. Now, the world considers U.S. Treasuries as having no credit risk. So when you buy a U.S. Treasury, you get 0 money for the credit risk. So you're going to demand a certain amount of money for your real interest rate. Let's say you want to make 1%, okay? That's what you really want to make. Now let's go to number 3, the most important one, inflation. You see, if I want a real yield, of 1%, and the bond has a nominal yield of 2%, so I'm going to receive 2%, that's good. But if inflation is 3%, I'm losing 1% a year because the value of the dollars, the value of my principal are declining by 3%. That's called inflation. And I'm only receiving 1% in my bond yield. So inflation is the most volatile and most important factor that affects bond prices. So we recently had the big reflation trade, and that caused the bond market to go into a big bear market. Interest rates went up because the feeling was we're going to have a lot of inflation. So we, the bond owners, we need to be compensated for that inflation so we can end up with a real yield. So if interest rates go to 2% and inflation's only 1%, I'm going to end up with 1% yield. 2% nominal yield minus 1% inflation gives me 1%. But all of a sudden we had 2% nominal yields and inflation at 5%, which meant that I was going to be losing 3% a year. Okay, so now, over the last several weeks, because the Fed has said, oh, no, we're vigilant. We're so vigilant against inflation, we're going to talking about raising interest rates in 2023. And that honestly shocked the market because they weren't expecting that. And they said, gosh, I guess the Fed is on the case here. And yes, inflation is transitory, and the Fed's going to raise interest rates to make sure that it doesn't get out of control. And therefore, yeah, it's 5% now, but it'll probably sag back down to 1%, where it's kind of been for the last few years. And therefore, a 2% yield, good enough, because that'll give me a 1% real yield. I think that is completely wrong, but that's what the market thinks. So right now, we're just past the peak of one of the largest bond bubbles in history. And in some ways, it is the biggest bond bubble in history. We have, when bond yields are close to, under 2%, under 1%, depending on the term, these are yields that we've never seen in the United States ever in history, which means that they're in a bubble. We've seen some other countries, German yields are negative, so their bond bubble is even worse than ours. All bubbles get burst. And we will eventually, it's a matter of timing, we will have a huge bear market in bonds where we will make huge amounts of money, okay? Now's not the time. We had a nice bear market in bonds, but right now we're in a bull market in bonds. So we can't be thinking that the bubble is being burst right now, but it will be burst. And I suspect within the next 2 years, maybe in the next 12 months, but not in the next month or two. Okay, look forward to your webinar, especially after reading your book on Forex trading. Can you comment on your best strategy on Forex trading? So I wrote a book called How to Make a Living Trading Foreign Exchange. It's on Amazon, published by John Wiley about 10 years ago, and continues to sell well. The book really covers swing trading and position trading, but not day trading. So when it comes to position trading, my go-to technique is channel breakout. Now, it's similar to the channel breakout that I teach to stock traders, but there are nuances. And the nuances, the additional rules are all in the book. The book's like $45 on Amazon, something like that. And there's also a Russian edition, believe it or not. It was translated into Russian. The swing trading, I like inside days. If I had to have one technique, it would probably be inside days. But the book also explains reversal bars. And we recently put out a course a few months back called My Favorite Day Trading Technique, which is an opening range breakout technique. Okay, so that's a course. The book is much cheaper. I would definitely start there. All right. When will I invest in crypto? Which is best? I'm not the world's biggest fan of crypto. And the reason is because most of the famous cryptos like Bitcoin and Ethereum, they're 100% backed by nothing. They're air. They have no value. So all we're doing is trading air. And there's an old joke about that when you buy a stock, the best technique for buying a stock is to find a greater fool than you. And that's all the crypto market is trading on, is finding greater fools than you to sell it to. So I could go into a longer dissertation about stable coins and so on and so forth. Bitcoin's the most popular. It's probably one of the worst because the technology of like Ethereum is a better technology than Bitcoin. And there's other ones that have some special capabilities that make them more interesting. But the reality is they're backed by air. They have no value. Whereas a stock, you own part of a company. Corn, you can always take delivery and eat it. Okay. So these things have real value. Bonds have a promise to pay back the bond. That's real value. What's the value of Bitcoin? Nothing. You say, but Courtney, the US dollar is backed by zero also. It is. It's totally worthless too. But the advantage of the US dollar is that, don't tell anyone, but everybody else thinks it has value. So I found millions, tens of millions, billions of greater fools than me. They'll take the dollar, but they won't take Bitcoin. Not at $30,000. What do I buy with $30,000? Oh, well, you could buy a nice car. Yeah, but no, that's against the law. You can't buy a car with Bitcoin. The feds won't allow you. You can't pay for it with cash anymore. You have to get a certified check. It has to go through the banking system. So there's really nothing you can buy for one Bitcoin. You can't buy a loaf of bread. So I'm just saying I'm not a big fan. All right. Now, having said that, I do trade crypto, specifically Bitcoin, because it is the most liquid of all of them, occasionally Ethereum. There's a lot of money to be made investing in crypto, but just remember, it's purely technical. There are no fundamentals because they're all worthless. All right, and I'm not going to talk about stable coins. All right, well, there's some small little coins that have some value, but that's another story. So you got to look at them from a technical perspective, use our basic technical systems like channel breakout and trend analysis that we talked about earlier. I wouldn't day trade because the bid-ask spread and the commissions are too high, unless maybe you did it on the futures market. And then swing trading is pretty hard too. Once again, the transaction costs are way too high. But here in Canada, I noticed that when I need to purchase some US funds, I notice when I buy, I get one exchange rate, and when I sell, I usually get a lower exchange rate. Can you give the best thoughts on how to keep my profits? Well, the problem is, of course, is that's the bid-ask spread for, let's say, US CAD. So the US Canada exchange rate has a bid and an ask, and you're paying, when you buy, you pay the ask, and when you sell, you pay the bid. Your problem is probably related to you want to hedge so everything is in Canadian dollars. Because if you buy something in a US brokerage account or in a US dollar brokerage account, if the US dollar goes up, that's great. You made money on the cash sitting in your account. But if the US dollar goes down, well, you've lost money. As a Canadian, you just want to trade Canadian dollars, but the world trades US dollars. So what you need to do is hedge your position. And Bud, just send me an email and I'll tell you how to do it. Send it to support@wealthbuilderllc.com and I'll tell you how to do it. Okay, it's very simple. Okay, couple more questions. The timing and position size of pyramid strategies. By the way, did you notice how high quality these questions were? These people are smart who asked me these questions. These are all really good questions. There's no dumb questions here at all. Okay, the timing and position size of pyramid strategies. Take West Texas Intermediate crude oil. It was a clear bull market since June 1st as your special report. So I put out a special report and there's a video about it on this YouTube channel. Go look up oil and you'll find it's about a 45-minute webinar that I did that explains why we're in a bull market. And by the way, everything in there is still valid. It's still a bull market. Okay. It had two significant retracements in mid-June and recently. If you were very sure that it was a dip, but not the end of the bull market, and want pyramiding to make more money, it's a trend. Would you buy the reversal bar after the dip or buy at the breakout of the previous high? And the answer is yes. I would do both of those things. So the market's in a bull market, it dips. We then get a reversal bar, which is a good signal that the long-term trend is reasserting itself. I'd buy some there. And then when it broke to new highs, I'd buy more there. So the answer is yes. Now, the next question is very interesting. How do you choose the size of the second or even the third position in the process of pyramiding? If you miss the best timing, when will you build a long position? So what you do is, let me answer the second one first. If you miss the first trade, buy the second trade. Follow the channel breakout rules and buy the next signal. If you're using trend analysis, buy the next signal. Either way, just get in on the next signal. That gives you discipline. Now, as for the size, the term pyramid comes from the original concepts of pyramiding. The idea is that first you'd buy 5 contracts or 500 shares, and then the next time you added to the position, you'd add 4 contracts or 400 shares, then 3, then 2, then 1. So it forms a pyramid. And the idea was that was a very stable base. The way I trade is more aggressive. The pyramid is more conservative. So take your pick, depending on if you're conservative or more speculative. What I use is a cone. If I'm buying 500 shares here, I buy 500 shares here, 500 shares here, 500 shares here, 500 shares there. Or the way I look at it is I take 1% risk, 1% risk. The risk on every trade is the same. So it ends up looking like this. The pyramid is more conservative, but you won't make as much money as the cone. So pick equal numbers if you want to be very aggressive. Use the pyramid if you want to be less aggressive and more conservative. Excellent, excellent question. And the strategies are the same in all instruments. Okay, Taiwan Capitalization Weighted Stock Index. Since 2020, as the flood of QE, most of the global markets went to new all-time highs. True. In Taiwan, the index made an all-time high and even rallied to 18,000, approximately 40% more than the previous high in 1990. However, on the experience of 1990, the bubble busted and the index plunged to 2485. So it went from 12,682 to 24. That's like an 80% drop in 1990. Would it collapse with a similar scenario as the global monetary politics changed recently? So I don't know that we've really changed monetary policy recently. The Fed is now talking about. The ECB has not said anything. Bank of England hasn't said anything. Bank of Japan hasn't said anything. So if we've changed the policy, it's talking about. In other words, not much. Several of these central banks have said they're going to continue at the same rate they are right now or for the next 2 years. ECB's basically said that. So I think the QE is still there, and that will continue to flood the Taiwanese stock market. But in 1990, the threat from China was not as great as it is today. Xi Jinping is pushing out naval power into the South China Sea. They're at loggerheads with a lot of different countries, the Philippines, Taiwan, etc. They're flying jet fighters over Taiwanese airspace. So the point being is, and they now have the largest Navy in the world, bigger than the American Navy now. So they're extending military power out. They've taken over Hong Kong. There are now more Chinese people in Tibet than Tibetans. And of course, we know about the destruction of the Uyghurs. So we're seeing a lot more military power coming from China. We're seeing economic pressure being put on Taiwan as well. So I look at this and I say, in 1990, it was an economic problem. Today, it's an economic and geoeconomic and geopolitical problem because China is now exerting power around Asia. Other parts of the world too, but primarily Asia. So that makes me worried that we could see another 80% collapse in the Taiwanese market, but not this year. It's not going to happen this year unless China were to attack Taiwan. Okay, now that's the caveat. But if they just stay at the level they are of aggression, then I think the Taiwanese market will continue to bull higher like all other markets until next year. Next year is more and more coming into my sights as a major bear market, but not this year. Okay, that is our presentation there. Let me come back over. There I am. Okay, so somebody said that the questions, you can't ask any questions. I don't know. I'm using new software. What can I say? I've never done a YouTube live, so we're doing the best we can. We'll figure it out one of these days. Who knows? Anyway, listen, I thought those questions were excellent. We're going to do this again. We got overwhelming positive response to the one we did this morning. And as you can see, and even the ones that the questions that I showed you, people were very excited about this concept of me answering questions. And since I have 50 years of experience and I've done just about everything in the field, I can answer most questions. I'm not a personal finance expert, but I think I'm an investing expert, maybe just a little bit. Who knows? Anyway, listen, I really want to thank you all for attending. Hopefully we answered the questions you want. And maybe we'll do another one of these in a couple, 3-4 weeks, something like that. All right, everybody. Thanks very much. We'll talk to you later.